Millionaires are passionate investors, and in order to continue to expand their fortune, they must avoid investing in the incorrect things. As a result, in this video, I'll show why the rich never invest in these 7 things, so you may make amazing investing selections and become wealthy. Following in the footsteps of those who have achieved before you are one of the finest ways to succeed in life. And this strategy certainly works in investing, which is why thousands of people spend endless hours studying the financial ideas of people like Warren Buffett and Charlie Munger. Surprisingly, these business moguls inherited their investment approach from their predecessors. Warren Buffett, for example, got his investment philosophy from Benjamin Graham, his teacher and author of The Intelligent Investor. Benjamin Graham is well known for his meticulous, even surgical approach to valuing businesses. Graham created a successful investing strategy based on basic, effective logic, based on his experience. This is the oldest saying: investing is a complex art, and knowing which investments to avoid is just as vital as knowing which ones to make. When it comes to growing your wealth, several typical investments can appear to be winners. The truth is that some can really cost you money over time, making them things you should avoid at all costs. Which investments do millionaires avoid in particular? Investment number 1. Precious metal. Precious metals, notably gold, are the thing that many wealthy individuals do not invest in. Now I see why some individuals invest in precious metals. In general, gold and other precious metals can be used as a hedge against economic downturns. This is because precious metals and the stock market have an inverse connection. Simply put, when stock and bond prices fall, gold and other precious metals rise. Whereas when stock prices rise, precious metals fall in value. Well, isn't it smart to have investments that will counter any losses that may occur, you could ask? Although this makes perfect sense in theory, the fact is that precious metals rarely rise enough to compensate for the losses incurred during an economic downturn, making them a poor hedging strategy. The other problem with precious metals, as with most of the other investments we'll be discussing in this video, is that they're illiquid. If you're in a financial crunch and need cash, selling these assets may be more difficult than you think, leaving you without the funds you require. If you need further motivation to avoid this form of investment, you should know that investing master Warren Buffett believes gold is a bad investment. Buffett feels that the stocks have historically provided a considerably better return on investment than precious metals. For example, if you invested $10,000 in gold and stocks in 1942, your gold will be now worth $400,000. This may appear to be a good return, but the same $10,000 put in equities today would be worth $51 million, demonstrating the power of stock investing. As a result, wealthier people are less likely to invest in precious metals. Investment number 2. Collectibles. Collectibles are the next type of investment that millionaires shun. Art, antiques, stamps, historic vehicles, wine, and comic books are examples of collectibles. And they are major business, believe it or not. According to a Deloitte estimate, the collections market was worth $362 billion in 2012 and was predicted to expand year over year. But despite the expected growth, millionaires are still hesitant to invest in collectibles for a variety of reasons. To begin with, collectibles are only worth what someone else is willing to pay for them. Therefore, there is no set price for these items. The asset prices are determined on how much other people think it is worth. Similar to cryptocurrencies, this means that while that nice painting you own may be worth a lot to you, it is worth nothing unless you can find a buyer willing to part with their money for it. To add to the problem, unlike stocks and bonds, there's usually little public information available for individual collectibles, making the valuation process even more difficult. The second reason why the wealthy do not invest in collectibles is that they do not create money. A painting may be beautiful to look at, but it will not fill your bank account on a monthly basis, making it a less than ideal investment to hold. The fact that collectibles are illiquid is probably their worst flaw. For example, it takes a certain kind of customer to spend thousands of dollars on an antique automobile or a comic book collection, which means that if you want to sell your antiques to make some money, you may have to wait a long time. To summarize, while collecting valuable objects might be enjoyable, they are not the best investments. Investment number 3. Deposit certificates. Certificates of deposit are another unpopular investment among the wealthy. let me clarify what certificates of deposits, or CDs, are if you're not familiar with them. A certificate of deposit is a bank or credit union product that offers a higher interest rate in exchange for the consumer committing to leave a lump sum deposit untouched for a set length of time. You're basically exchanging access to your money for interest income. Unfortunately, CDs share the same major drawbacks as bonds. They don't provide a high rate of return, making it difficult to beat inflation by investing in them. In fact, the highest CDs are only yielding 2.25% yearly as of September 2019. One advantage of certificates of deposit is that they typically have shorter term than bonds, allowing you to earn a similar return while being without access to your cash for a shorter amount of time, resulting in lower risk. While CDs aren't bad investments, millionaires demand larger returns and rely on them to grow their money faster, which is why certificates of deposits aren't the wealthiest preferred investment. Investment number 4. Cryptocurrencies. Everyone has been talking about Bitcoin and other popular cryptocurrency for the past several years, but billionaires tend to avoid this form of investment. I'd be lying if I said that there haven't been people who have made millions investing in cryptocurrencies, but they are few and far between. The first issue with digital currencies is that they are not regulated by the government, which means that there is no monitoring into how the companies behind them operate, which can be concerning if you're investing huge quantities of money in them. The second issue with cryptocurrency is that it lacks intrinsic value. Their value is completely speculative, similar to penny stocks, with prices rising when there's a lot of buzz and falling when the buzz dies down. For example, when Bitcoin received a disproportionate amount of attention in December 2017, the price of a single Bitcoin rose to over $17,000. As attention shifted away from Bitcoin, the price began to fall, and investors saw their once loved cryptocurrency trading at just over $3,000 1 year later. Finally, unlike traditional investments, digital currencies are vulnerable to cyber attacks and theft. Consider the case of Bitfinex, a Bitcoin exchange. Depositors lost around $70 million in 2016 because the platform was hot. Unfortunately, this is not an unusual occurrence. According to a survey conducted by the US Department of Homeland Security, nearly 1/3 of all Bitcoin exchanges had been hacked at some point. When you consider all of these factors, as well as the fact that cryptocurrencies do not generate income like investment properties or dividend stocks do, the conclusion is clear. Millionaires rarely use digital currencies as their primary investment vehicle, which is understandable. Investment number 5. Penny stock. Penny stocks are any stock that trades on a stock exchange for less than $5 per share, and millionaires shun them like the plague for a variety of reasons. Millionaires shun this form of investment. First, corporations that trade low-value stocks are exempt from having to register with Securities and Exchange Commission, or SEC, and from having to submit yearly reports to them. In other words, there is no monitoring into the accuracy of the financial data these companies disclose, making them extremely risky investments. Furthermore, the lack of access to reliable financial data makes it difficult for investors to determine the genuine worth of their holdings, which is a significant aspect in successful investing decisions. Sure, these stocks offer the potential for exponential rises and large profits for investors willing to take a chance on these unproven businesses. But millionaires are well aware that many stocks it will eventually tumble. Another reason penny stocks are lousy investments is their low liquidity. Because most people don't invest in this type of companies, finding a buyer for one you own might be difficult. While most popular stocks are bought and sold thousands of times every day, penny stocks are bought and sold less frequently, which has an impact on their price. Holding volatile investments makes it difficult to determine the true value of your holdings, and can make investing uncomfortable as you watch your money grow and fall to extraordinary amounts over time. As a result, millionaires avoid penny stocks for these reasons. Investment number 6. Bonds. Many millionaires do in fact have bonds in their portfolios. When millionaires attempt to maximize their wealth, they prefer to avoid this form of investment. The first disadvantage of bonds is that their returns are often smaller than those obtained by investing in equities. Many bonds, in fact, barely keep up with inflation, yielding an average of 3% per year. For example, in the United States, The average yearly inflation rate has been just over 2% in the last 3 years, which implies that a $50,000 investment will yield a net return of 1% or $500. So, why would anyone buy in bonds in the first place if the rates are so low? Bonds, on the other hand, are generally less risky than stocks and are more liquid, meaning that if you choose to sell them, you can get your money immediately. Bonds also pay interest, making them income-generating investments. Unfortunately, their poor returns make them more of a wealth preservation instrument than a wealth-building one, which is why millionaires avoid investing huge quantities of money in them. Investment number 7. Companies you don't understand. At this point, you've undoubtedly concluded that stocks are the form of investment preferred by billionaires. But not all equities are smart investments. This is because many companies that trade on the stock market are so complicated that the bulk of investors have no idea what they're investing in. In fact, seasoned investors like Warren Buffett, who has been investing for longer than most individuals have been alive, will not participate in most companies due to their complexity. Buffett preaches the necessity of only investing in firms you understand, and he follows his own advice by only investing in companies that fit within his circle of competence. Only enterprises that come within his circle of competence are considered for investment. Buffett argues that you can't forecast performance if you don't understand the business. Buffett, for example, did not take a hit when the dot-com bubble burst in the early 2000s because he was not substantially involved in dot-com stocks. To summarize, stock investing is a strong instrument for increasing your wealth, but you should only invest in firms that you understand. Finally, if you want to start investing like a millionaire, you should avoid bonds, penny stocks, digital currencies, collectibles, certificate of deposits, precious metals, and companies that you don't understand. That's all, folks. Thank you for watching. Subscribe, like, and comment for more content. See you in the next one.